Hello, everybody. Chuck Carnevale, co-founder of FastGrass, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another 2-minute drill, lessons in valuation subscriber request series. Of course, one of the most often stocks I'm asked to look at is the mighty Microsoft. AAA rated, less than 23% debt, and 13% historical growth. But there are some interesting lessons in valuation with Microsoft. This is the business, and the business obviously has been excellent. And the dividend line is the white line. They did pay a special dividend back in 2005, but normally their dividend has grown at a very healthy rate, as you can see, and their payout ratio still remains low at 25% or even less. All right, but when I put weekly closing stock prices, a couple of things to note. Up until we get into really towards the end of 2015 or 16, this stock traded at a reasonable valuation. It traded at around 15 or so times earnings, 18 times earnings. There was even a time where we got into 10 times earnings, and even at times here it hit single-digit PE ratios. And this was a time when their earnings growth was relatively flat. They had come off with some good years in 2010 and 11. Their fiscal year ends in June. Then they had a 3% year, a -7, a 2, a 0, and a 6% growth rate. And it was during this period where the stock was trading at a low valuation. And then, despite the fact that it's a $2.8, almost $2.9 trillion company today, you can see starting in 2017, they really start growing very fast again, and they've maintained that double-digit growth rate since. We can shorten the time frame here, and we can see that the company's been averaging almost 18% growth. For a company this large, that's huge. I do think the stock is very highly valued. The market has been putting this premium valuation in more recent years, starting almost really in 2017 or 18, and we've had these 29 multiples. From a forecasting point of view, the stock, based on a normal multiple, looks undervalued, how the market's been applying it. Based on an intrinsic value assessment, it looks significantly overvalued. But what's interesting is when you look at Microsoft from the point of view of peaks and troughs, when you overpay even for a great stock like Microsoft, you don't necessarily do great. That's less than a 6% rate of return going back to November where it peaked. But if you do buy it when the valuation is low, you do have opportunity to make some pretty healthy rates of return. Valuation matters, and it matters a lot. I like Microsoft. I think it's gotten really highly valued here, but there were some reasons for it because they did have some acceleration in growth. Even if I look at the last 8 years, it's still 17% growth. The analysts are forecasting the company to continue to grow greater than 15% going forward. And if the market continues to give it a premium multiple, it would be attractive today. But it is a little risky because of valuation. Anyway, this has been Chuck Carnevale. Thanks for watching. If you enjoyed the video, ring the bell, give me a like, subscribe to our YouTube channel, and take a look at subscribing to FastGrass because it can really help you measure the value of the business versus the value of the stock. Thanks for watching.